Okay, it's 4 o'clock now. Good afternoon, everyone. Welcome to the October version of Making Sense of the Market with Chris Kerlow and Team LWC. Thank you to everyone for taking time out of your day to join us. Before I pass things over to Chris, my name is Adam Miller. I'm the newest member of Team LWC, focusing on marketing and supporting Chris and Mitchell in their day-to-day. If you have any questions, please put them in the Q&A box and we'll address them at the end of the session. This month's edition is titled Fall is in the Air, where Chris will walk us through central bank policy, commodities, critical minerals, and dividend-paying stocks. I'll pass things over to Chris. Take it away, Chris.
Thank you, and welcome everybody to this month's edition. Falls in the air was a bit of a literary pun, as we obviously saw markets move meaningfully lower in September, something that we talked about, the challenging seasonality during the fall period, particularly September. It has percolated now into October, as it's been a tough couple of days for the markets already so far this month. A lot of that has been on this precipitous rise in bond yields. You can see this in the chart on the top right. That's the US 10-year bond yield. It's moved meaningfully higher over the course of the past several months, and really intensified that sell-off in September. The reason I refer to it as a sell-off is as bond yields move higher, bond prices move lower. The other problem that this creates for equity markets is companies that would be classified as long duration assets, meaning companies that have a lot of money that they're going to make in the future. From a discounted cash flow standpoint, when we look at companies and valuations, we bring those cash flows back to the present. And so when you're bringing them back to the present, you're using a discount factor. The larger the discount factor, the less value those future cash flows have. And thus, this is how the long-term bond yield of treasuries, or the risk-free yield, as it's called in dividend discount modeling, works into that equation. Why is it going higher? I spoke about this yesterday on BNN, but the points I'll reiterate again today are a big part of it is, we saw the US avoid a government shutdown this week, agreeing to spend more money they don't have. And this is basically the market telling the Fed that, we're going to demand higher payments to issue more treasuries to pay for that debt. The other problem that we face now is that the buyer of those treasuries, the biggest buyer, the US Federal Reserve, through their quantitative easing program, which was essentially buying treasury bonds in the open market, has ended. You add to that banks in the United States, who could be other buyers of these treasury bonds, don't have the capital flexibility to do so. And then lastly, would be large sovereign nations such as Japan, China, Russia, and otherwise are now looking to actually reduce their US Treasury and US dollar exposure and transfer out of the United States, or dollars, put another way. So all of that has led to this higher bond price. Concurrently, the impacts on the short end of the curve, which is what the Fed can control, which is Jerome Powell and co., mentioned that they will be keeping rates higher for longer. That's also percolates, throughout the Treasury curve as people predict what does longer mean. And so you're seeing these larger or longer term rates moving up. What the chart we're showing here on value versus growth, you obviously saw this great run in growth stocks, value stocks last year, as bond yields were rising. That was coming as we had a massive tech sell-off. Tech assets are typically classified in that long duration camp. You could think of, an AI company that's burning cash today to make exuberant profits later in the future. Same is true with a lot of technology companies. But that has put us into this value camp, thinking that, you could see the correlation over the last little while break apart here recently. We think that this value trade comes back. We'll talk about where we see some of that value coming up here in the next couple of slides. Before I get to that, I'll just touch on a couple other opportunities. It's, has us kind of waning out of some of the tech and consumer discretionary leadership. We've talked about that in recent trade rationales. And a lot of this higher for longer chat from the Fed is coming from sticky inflation. We saw CPI reaccelerate to 4% in August, up from 3.3% the month before. And we're seeing similar things happen in the United States. And the fear is that that could be around for longer now with elevated energy prices. We are large believers in the energy transition into clean fuel. And that's really one of the reasons why we're behind this energy trade. We've added an actively managed energy mutual fund to many of your portfolios recently. That trade is a hedge against inflation, as oil is a key part of everything we manufacture and produce and transport. And so higher energy prices do percolate through the economy and can lead to higher inflation. We believe that the recent gain in oil from 70 to about $90 really hasn't been reflected in a lot of the stock prices. The manager that we're using for this fund is one of the best in class out of Calgary, Alberta, focuses solely on this. We own energy names in a lot of your portfolios, names like Enbridge, Topaz, Occidental Petroleum, for some direct energy exposure. But we think near term that in the upcoming earnings seasons, we should see some positive results coming out of these companies. Unlike before, typically in Texas and in Alberta, when you get this run in oil, people run to those drilling wells and start bringing online new wells. We haven't seen that. We've seen a much more prudent capital deployment strategy out of these areas. That should bode well for free cash flow. And so our thesis here is that we see some positive free cash flow generation, better than expected out of the names inside of this portfolio, while likely sustained higher energy prices. The risk to that is that we aren't the only ones that think something that's gone up is going to keep going up. It's not a trade that we typically do. We like to buy low and sell high. We'll talk about that on our last slide of the day today. But in this trade, we think with Saudi Arabia and Russia cutting roughly 1.4 million barrels a day, that's put the market into a structural deficit. And in the United States and Canada, our oil producers are being encouraged by the government to drill, baby, drill, as that should help bring more oil to market, which would drive down prices, which would help curb inflation. Is kind of like the roll-on effect that thesis has behind it. There's also could be some boons if we don't get a very warm winter in Europe. Unfortunately for that country, we could see natural gas prices move higher on that. And a lot of natural gas comes out of these oil wells, and natural gas liquids are growing even faster than natural gas. And so a lot of that could be shipped overseas in the form of liquefied natural gas, which would be another boon for this group of stocks. And then the oil patch is a interesting dynamic area with hedging programs and the alike. And so we focus on, the three large cap names I mentioned earlier, but we like the capability and capacity of this team to go up and down and across the sector, as there are services, integrated pipelines, et cetera, that take place in the energy complex. So that's an area that we like amidst all of the uncertainty out in the space. We're also very bullish, which is, positive on uranium and copper. Uranium, we think, could be the baseline fuel necessary for this energy transition. And I might not have finished that point earlier about our bullishness on the energy transition leading us into hydrocarbons, which is, oil. The fact is, that is just now so obvious and so underinvested in that is causing these structural deficits. We see a similar type of environment in the uranium space. Last year, reactor demand was 178 million pounds of uranium, while primary production was only 130 million. We see that gap only intensifying, particularly as you look at the chart on the bottom right. There's very little supply coming on. We participated in a small flow-through transaction in the space. Space has done well, so challenging to really add to it right now, up 16% last month, while the market was down 4 or 5, depending if you're looking north or south of the border. Concurrently, we also like the copper area. We're looking for some opportunities there to transition some of our smaller mining exposure into the copper space. Copper is necessary to transmit all of this energy and build out a new electrified grid for EVs and likewise. So again, another structural imbalance at that point. You bring all of that together at the same time, you're having this reshoring where energy security is of the utmost importance and top of mind in 2023. Lastly, the dividend space. This is one of the areas we see some of the most value, has done not so well here in Canada. We're looking at utilities and telcos near 52-week lows. Banks have had a challenging time, pipelines as well. Longer term, though, we just want to reiterate your risk to reward. You're seeing that on dividend growers, which is what we focus on in the LWC Canadian dividend growth model. Outperform with lower risk over time, even better than dividend payers with no change, and companies with non-dividends, and much better than those that are cutting dividends. And then these do tend to be areas to find some reprieve. We haven't seen it so far in this pullback, but we do believe valuations matter at the end of the day, and one of the things that we need to rely on. And so we continue to have exposure to this Canadian dividend sector in our models and across our business. For many of you, still a lot of confidence in these names. We might be looking into even doing some sort of structured note products near the end of the year, just basically betting that these companies are going to be higher and maybe meaningfully higher in 3 to 5, 7 years from now. And we can, through a structured note, make an accelerated bet on that with some sort of protection to the downside. So that could be something we talk about in future webinars about what that is and what that looks like.